So this is the eighth and final episode of Module 1. Over the past 7 episodes, we've built the full 3-engine wealth system. We've covered what each engine does, we've covered why they're sized the way they are, we've covered how capital flows between them, and today we're going to stop talking about the system and start running it. We're going to walk through a complete month, start to finish. We'll use the planned numbers from month 1 of the $1 million experiment. These come straight from the $1 million experiment blueprint. They are the projected figures the plan is built around, and not actual results from live trading. The $1 million experiment update channel will show you how the real numbers compare over time, but today we're going to walk the plan. Now, one thing to be clear about before we start is that the purpose of this episode is not to teach you trading or investing mechanics in any kind of depth. Those mechanics belong to the mentors you'll work with through your virtual investing organization. The purpose today is simpler. Is to show you what a month in this system actually feels like. The rhythm of it, the decisions, the handoffs between engines, and then the scorecard at the end of it. By the time this episode is over, the system should feel like something you can run, not just something you understand. And one more thing about the month 1 numbers. Month 1 is the smallest month the system will ever have. The income engine is working with $3,000. The growth engine is working with $2,000. The accumulation engine has nothing. The dollar amounts are small. And that's the point. Month 1 is about building the process, the habit, the discipline, the muscle memory. You will run this system for 5 years, so don't judge everything by month 1. Judge it by month 24 on the way to month 60. The month starts with the income engine. On day 1, $3,000 of external contribution arrives in the trading account. That's the phase 1 allocation. The account balance is $3,000. In the $1 million experiments approach, we're going to be trading micro ES mini S&P 500 futures. That means one contract. The specific method used to find and execute trades, again, is the domain of the income engine mentor that you work with through your virtual investing organization. Every approach, whether it's futures or options or stocks or Forex, each one has its own entry rules, exit rules, and risk management. In the $1 million experiment, the risk rule for MES futures is 2.5% of the account per trade. On a $3,000 account, that's $75. That's specific to this instrument and this approach. Your own method may have its own rules. Now, not every session will produce a trade. The method your mentor teaches will tell you when a setup is worth taking and when it's not. Discipline means sitting on your hands when the condition's not right, even when you feel the urge to do something, which is a lot of the time. That discipline is what keeps the risk management rules intact. In month 1 of the $1 million experiment, the income engine target is $249 for the month. That is 8.3% of the $3,000 starting account. Now, spread across roughly 21 trading days, that works out to be like $12 a day on average. Now, some days will produce more, and some days will produce less, and some days will produce a loss. The monthly target is not a daily target. It's what the process should add up to across the full month. And of course, every trade gets logged. The trade log is the primary management tool for the income engine. For each trade, you record the date, the instrument, the direction, the entry price, the stop price, the exit price, and the dollar result. You also add a short note on whether the setup was a good one, according to the method, or not. And that last part matters, because a losing trade on a good setup is just a loss. It happens. But a losing trade where you broke your own rules is a more serious problem. And the log is what lets you tell the difference. The log also builds something else over time, evidence about your own trading behavior. After 3 months of entries, patterns become visible. Maybe you consistently take good setups on Monday, but get impulsive on Friday afternoons. Or maybe you follow the method perfectly when you are up on the month, but start bending the rules when you're behind. The log reveals these things. Without it, you can't see them. But with it, you can fix them. And that's why logging is not optional. It's the feedback mechanism that makes improvement possible. By the end of week 2, there are trades on the log. And here's something important. Whether you are ahead of the monthly target or behind it at this point does not change what you do. The method stays the same. This is one of the hardest disciplines in trading. You want to size up when you're winning, and you want to switch the method when you're losing. Both of those reactions destroy accounts over time. The process is constant. The results may vary, but log the trades and follow the method. Let the month finish. It's also worth noting what you do not do in weeks 1 and 2. You do not check the overall system balance every day. You do not panic if the income engine has a losing session mid-month. And you do not change the growth engine position because the broader market moved. Each engine operates on its own timeline and its own criteria. Week-to-week noise in any one engine is not signal, it's just noise. What matters is where each engine lands at month end, and whether the process was followed to get there. Now, while the income engine is trading, the growth engine is also running. $2,000 arrived in the growth engine account on day 1. In the $1 million experiments approach, that means starting the wheel strategy. The first step is finding a quality company with a liquid options market and selling a cash-secured put. The premium is collected, the position is logged, and that's the growth engine's work for the month, at least until the expiry date approaches. The time demands for these two engines are quite different. The income engine needs regular attention every day. Trading sessions, monitoring, daily log entries. The growth engine, though, running the wheel strategy is much more episodic. Once the first put is sold, the next real decision point is about 4 weeks away at expiry. And in between, the position runs itself. And that's part of why running both engines for month 1 is more manageable than it sounds. They don't both demand your time at the same moment. Now, by week 3, the growth engine put is approaching expiry, and two things can happen. If the stock stayed above the strike price, well, then the put expires worthless. This means you keep the full premium, and the cash is freed up. You log the result and start looking for your next position. The wheel has completed 1/2 of its cycle. In the $1 million experiments month 1 plan, the growth engine return at the 1.5% planning rate on a $2,000 base is $30. And yes, that's a small number. But the trajectory over years is what matters here. Month 1's $30 on a much larger base 2 years from now becomes a very different number. If the stock fell below the strike price, then the put gets assigned. That means 100 shares of the stock arrive in your account at the agreed price. This is not a bad outcome. It was one of 2 possible outcomes that you accepted when you sold the put. You now own shares in a company that you chose deliberately. The next step is to sell a covered call on those shares. Collect more premium. If the stock rises above the call strike, those shares get called away and the full cycle completes. And if not, you collect premium again and repeat. The wheel keeps turning. The accumulation engine check-in in week 3 is very short. In month 1, the accumulation engine has received 1 transfer, possibly. Actually, in month 1, it hasn't even received the transfer yet. It won't receive the transfer of 10% of the growth engine's month 1 return until the end of month 1. So it won't have any money during month 1. It'll only have that 10% during month 2. That's essentially $3. It sounds almost funny for an engine that is supposed to be building long-term wealth. It's such a small number. But it is the correct number for month 1. And it's worth understanding why rather than dismissing it. The accumulation engine's early transfers are small because the growth engine's early base is small. As the growth engine grows, which it will month after month, the 10% transfer grows with it. And from month 7 onward, $500 per month starts to flow in directly on top of the transfer. So the $3 is the seed, but the portfolio grows from here. Now, there's no action required in the accumulation engine in month 1. $3 does not establish a thesis position. It sits in the account and waits alongside the transfers that will follow in the coming months. This check-in simply confirms that the transfer arrived and updates the running total. Think of it this way. The income engine measures itself monthly. The growth engine measures itself quarterly. The accumulation engine measures itself yearly and over multiple years. Judging the accumulation engine by its month 1 balance would be like checking to see if a planted seed the day after you put it in the ground has actually grown. It doesn't make any sense. You have to give it time. The question is not whether it's grown yet. The question is whether the conditions for growth are in place. And they are. Month 1 of the accumulation engine teaches a different lesson as well. It forces you to start thinking about thesis positions. Which trends you believe in, which opportunities you want to pursue, and how you will size them when the capital becomes available. The $3 is not going to buy anything yet, but the thinking you do now about where to deploy it, that matters. By the time month 7 arrives and the $500 direct contributions start, you want to have done that thinking already. You want to have identified the first positions that you're going to establish. Use the early months to do the research, not the spending. At the end of month 1, you fill in the scorecard. 3 rows, 1 for each engine. Each row has the same structure: opening balance, target return, actual return, closing balance, and then a short performance note. Together, they tell you exactly how the system performed. For the income engine, opening balance, $3,000. Monthly target, $249. Actual result, whatever the trade log shows. In the $1 million experiments month 1 plan, the engine hits the target exactly, $249. Closing balance would be $3,249. No income paid out, no transfer to the growth engine, all the profit stays inside the engine. For the growth engine, opening balance, 0. Contribution received, $2,000. Monthly return at the 1.5% planning rate, $30. Transfer to the accumulation engine, $3. That's 10% of the 30. Closing balance, $2,027. It grew by $27 after the transfer. The number is small, but the process is the right one. Accumulation engine, opening balance, 0. Transfer received at month end, $3. No return. The transfer arrives at the end of the month, so there's nothing invested during the month to earn on. Closing balance, $3. No positions established. The engine is funded, but not yet deployed. Total system assets at the end of month 1, $3,249 in the income engine, plus $2,027 in the growth engine, plus $3 in the accumulation engine. That's approximately $5,279 in total. The external contribution for month 1 was $5,000. So the system generated about $279 of new value on top of the contribution. That's the beginning of the compounding. Now look ahead to month 2. The scorecard tells you where each engine starts. The income engine carries forward $3,249. But on day 1 of month 2, the next $3,000 phase 1 contribution also arrives. That takes the income engine pre-trade balance to $6,249. That crosses the 2 contract threshold. So month 2 runs at 2 contracts of the MES. The monthly target is not simply double the month 1 target, it's 8.3% of the $6,249 balance, which comes to approximately $519. So the account has scaled in 1 month. That's the system working. The growth engine starts month 2 at $2,027, then receives a fresh $2,000 contribution on day 1, taking it to about $4,027 before the month's return. The accumulation engine begins month 2 at $3 and will receive another growth engine transfer at the end of the month. Now here's something that's easy to overlook when the absolute numbers are small. In month 1, the income engine produced an 8.3% return. The growth engine produced 1.5%. On a monthly basis, those are modest returns, they seem. But really, they're not modest returns. They're exceptional by any standard measure. The numbers feel small because the base is small, but not because the returns are weak. Apply those same return rates to the balances the system will have in month 24, and the picture looks completely different. And that's what the 5-year plan is built to show. Now here's a way to make it concrete. In month 1, the growth engine earned $30. In month 24 of the $1 million experiment plan, the growth engine's balance is substantially larger. The direct contributions have continued. The returns have compounded, and the income engine has been feeding it. The same 1.5% return rate on a much larger base produces a much larger absolute number. The percentage does not change, but the dollar amount does, and that's the compounding. And it's the reason why the early months, where the numbers look small, are still worth running correctly. Every month you get right adds to the base that later months compound on. Now before we close Module 1, let's talk about what happens when a month does not go to plan, because it will happen. If the income engine misses its monthly target, the first question is not what to change. It is what happened. Just go back to the trade log, look at the losing trades, and understand, were the setups valid according to the method? Were the losses within the risk rule? If yes, then the month was actually a success from a process standpoint. The method was followed correctly, and the market just went the wrong way, and that happens. It's not a reason to change anything. If the review shows that some of the losses came from breaking the rules, taking trades that the method would not sanction, letting emotion drive a decision, ignoring the risk limit, well, that's a bigger problem than the P&L number. The fix is not a new strategy. The fix is returning to the process. If the growth engine underperforms, premiums were lower than expected, or an assigned position is temporarily underwater, ask the same question. Was the stock selection sound? Were positions sized properly? If yes, then the underperformance is market-driven. Stay the course. If the stock turned out to be lower quality than it appeared, well, that's a lesson for the screening process, not a reason to abandon the growth engine approach. One rule applies across all three engines. Do not change the system based on one bad month. The engines are designed to be evaluated over rolling 3-month periods at minimum. One bad month or even a bad quarter is not evidence that the system is broken. It's evidence that the system is operating in real markets, which have both good and bad periods. Now that's the end of Module 1. That's all 8 episodes. The complete 3-engine wealth system from the problem with conventional investing all the way through to real month running end to end. You now have a mental model that is complete enough to evaluate. You know what each engine does, how they're connected, how capital flows between them, and what a month of execution looks like in practice. And you have the $1 million experiment running in real time on the second channel. Every weekly update is a real data point that you can check against everything we've covered in this module. Now the next module, Module 2, addresses the question of how you actually build the skill to run this. Finding mentors, evaluating them, building a virtual investing organization that supports every engine, that is what the next several episodes cover. Because the system is only as good as the people helping you execute it. Here's a useful way to think about where you are right now. You have the architecture, you understand what the 3 engines do, how they're funded, how they connect, and what a month of operation looks like. What you don't yet have is the specific expertise to operate each engine. The trading method for the income engine, the systematic investing approach for the growth engine, the thesis selection process for the accumulation engine. Module 2 is about building that expertise through the right mentors. After that, more content will help you choose the specific approach that's right for you in each engine. The architecture comes first, and then come the expertise. One thing before we go. Everything in this module is documented live in the $1 million experiment. The trade logs, the wheel strategy positions, the accumulation engine transfers, all of it shows up in the weekly updates on the $1 million experiment channel. Those updates are not polished highlights. They're the actual scorecard. If this framework has connected with you, watching those updates alongside these episodes is the fastest way to build real intuition for how the system works across different market conditions. Remember to subscribe to both channels. Module 2 starts next. I hope to see you there.